shutdown costs, and project NPV. In the last few modules, we've been working through these typical cash flows from a project, and we have one more to deal with before we can move to calculating the NPV of the project. So far we've dealt with the ongoing or yearly cash flows, the initial outlay, and most of the terminal cash flows, the salvage value, the tax resulting from a profit or loss from sale of an asset, and the recovery of the net working capital. The final cash flow is shutdown costs. In the module where we discussed the initial outlay, it was important to distinguish between items that would be capitalized for depreciation purposes and items that would be immediately claimed as a tax deduction. Shutdown costs are legitimate expenses of the firm and therefore a legitimate tax deduction. But there's no opportunity to capitalize shutdown costs and depreciate them over future years. So all shutdown costs can be taken to be tax deductible. Therefore, when we say shutdown costs, we're really talking about after-tax shutdown costs. Shutdown costs comprise any expenses that are incurred after the end of the project. Since these are tax deductible, they will result in a tax shield, which is a reduction in tax payable because of a tax deduction. The value of the tax shield is the negative of the tax rate times the shutdown costs. After Project Alpha finishes, the firm will spend $80 on cleanup costs to restore the project site to the condition it was in before the project. These costs are tax deductible and the tax rate is 30%. These are the incremental free cash flows that we've arrived at so far. What are the incremental free cash flows in year 5 after taking into account shutdown costs and the tax shield? The shutdown costs are clearly a cash flow, so they go in unchanged at negative $80. The tax shield is equal to the negative of the tax rate times the shutdown costs of negative $80, which results in a positive $24. A tax shield is an incremental cash inflow because the firm is $24 better off as a result of the tax deductible shutdown costs. An alternative approach is simply to calculate after-tax shutdown costs in one calculation. We always calculate after-tax values by multiplying by 1 minus the tax rate. In this case, the cash outflow of negative $80 is multiplied by 1 minus the tax rate, or 0.7. Even though $80 in cash is being paid for the shutdown costs, the net result, after taking into account the tax deduction, is a cash outflow of $56. The final step is to calculate the NPV of a project. This is a generic formula that we've used before, which gives us the NPV of a project. It's the sum of all the future cash flows discounted to a present value minus the initial outlay. The formula that we need to calculate the present value of each cash flow is from the topic on financial mathematics, where the future cash flow is divided by 1 plus r to the power of n, where n is the number of periods in the future. We can expand that out. This version of the formula shows us calculating the present value of all cash flows from C1 to Cn. In the case of Project Alpha, the cash flows take place over the next 5 years. So this is the specific formula for the net present value of a 5-year project. These are the final incremental free cash flows for Project Alpha after dealing with all the different cash flows over the previous few modules. Negative $1,075 in year 0, $341 from years 1 to 4 inclusive, and $124 in year 5. If the cost of capital is 8%, what is the NPV of Project Alpha? This is one way to calculate the NPV, by treating each cash flow separately and discounting to a present value. And often that's the only way to solve the problem if the cash flows differ from year to year. But in this case we have an annuity of $341 for 4 years, So we can use our annuity formula to calculate the present value of those cash flows, plus the present value of $124 in 5 years, minus the initial outlay, gives us an NPV of $138.83.